Learning objectives: understand tax implications of covered calls and SPY DCA. Disclaimer: I am not a tax expert nor certified in taxes. Please work with your tax professionals. Learn the risks that can affect the strategy's performance. Know how to manage market drawdowns, high volatility, and assignment events. Prepare a rules-based response plan for different scenarios. Section 5.1, Tax Treatment of SPY and Covered Calls, US Focus. Key tax points: asset, treatment. SPY shares, long-term capital gains if held greater than 1 year. Call premium, not assigned, short-term capital gains. Call assigned, premium becomes part of sale proceeds, adjusts cost basis. Wash sale rule does not apply to options unless you close/reopen with same terms. Example: buy SPY at $480, sell call at $500 for $3. If assigned cost basis becomes $483, gain equals $500, $483 equals $17 per share, capital gain. Always consult a tax advisor. This course teaches the concepts, not personal tax advice. Section 5.2, Strategy Risks and Trade-offs. Key risks: type description, mitigation, assignment risk. You may have to sell SPY if price exceeds strike. Use OTM strikes, delta 0.15 to 0.20. Market crash: SPY can fall 20% plus in bear markets. DCA and lower cost basis plus long-term recovery. Lost upside: SPY rallies hard. You cap gains, accept as trade-off for income. Low premium periods: volatility drops, premiums shrink. Adjust strike or skip cycles. Behavioral errors: fear, greed, overtrading. Follow rules and process checklists. Section 5.3, What to do in a drawdown scenario. SPY drops 10% in 2 months. Response plan: don't panic, sell. This is a long-term position. Keep DCA investing. You buy more shares at lower cost. Adjust call strikes. Move farther. OTM: delay writing calls temporarily to avoid assignment at a loss. Use lower delta, 10 to 15, until recovery. Covered calls won't protect you from a crash, but they reduce the pain slightly. Section 5.4, Risk mitigation tactics. Tactic: when to use sell lower delta calls when market is volatile or uncertain. Sell calls less frequently during steep market drops. Pause call selling if you're deeply underwater and risk selling at a loss. By protective puts. Advanced: in extreme uncertainty, hedging strategy. Keep cash reserved to DCA into deeper dips. Section 5.5, Position sizing and allocation. How much of your retirement should go into this strategy? Rule of thumb allocation: conservative 20 to 30% of equities in SPY plus calls, moderate 40 to 60% of equities in SPY plus calls, aggressive 80 to 100% if you are retired and fully indexed based. Use the covered call strategy on only the SPY shares you're willing to sell if assigned. Section 5.6, Case study: navigating 2020 or 2022 scenario. Market drops 30%. For example, COVID crash or inflation. Drawdown: SPY goes from $480 to $340. Covered call writer kept DCA investing, paused calls for 60 days, resumed at lower delta. Recovered with strong position and lower average cost by 2021-2023. Key takeaway: staying invested plus staying disciplined beats trying to time the rebound. Section 5.7, Assignment: build your crisis plan. Instructions: outline what you will do if SPY drops 10%, 20%, or 30%. SPY rallies 15% in 1 month. 4 drops and premiums shrink. Include call strike strategy, DTA continuation plan, emotional decision, guardrails. Deliverable: 1-page PDF personal response plan. Section 5.8, Quiz. Optional question 1. What happens to covered call premiums in low volatility markets? A. They increase. B. They disappear. C. They shrink. White tick mark emoji. D. They become tax-free. Question 2. What's a smart move if SPY drops 25% and you're holding long shares? A. Sell more calls. ATM. B. Sell shares immediately. C. Keep DCA investing and pause calls. White tick mark emoji. D. Use 100 delta calls. Thanks for watching. For similar content, please like, share and subscribe. See you in the next module.